everyone. I'm Dale Pinkert. You probably know that by now after we've been broadcasting on YouTube for a few years now. We have a great guest today. I'm going to be speaking with Mike Lombardo, and Mike is with TradeView Markets. He's the head of equities and business development, risk management. Gosh, Michael, you do it all, and it's great to see you.
Many titles, yes.
Yeah, so
and thanks for
great to
having me.
see you and meet you.
Yes. Listen, you and Mike V have done a tremendous job on here growing this platform, and give you a great deal of credit for it. So well done. Job well done here.
All right. Well, yeah, Mike and I say 1 + 1 = 11. So anyway, Mike, I want to start off and talk a little bit about your journey in the industry and prior to joining TradeView, which was what I believe about 7 years ago.
Yeah, it was actually in 2017. I'm coming up on my five-year anniversary in October. When I took over the desk. But I started. Well, I'll go back. I mean, I started in 1990. I graduated in 1996 from Hofstra University in Long Island, and then my first job, I was a human resources analyst for a consulting company called William Mercer in New York, in Manhattan. Absolutely hated it. Couldn't get out of there fast enough. And I answered an ad in a paper for a new company that was looking to open up a trading floor in Syosset in Long Island, here in New York. And 1997, I started trading equities. Started trading a prop account in 1997. Struggled my first year, struggled mightily.
Yes, most do, Michael.
Absolutely. It took me a year. It took me 1 year to figure it out. However, when I did figure it out, a whole new set of stocks came to the market. Amazon, Yahoo, and all the internet plays started really taking off, and I was able to take advantage of that. And from 1998 to 2000, basically until the market crashed, until about 2001, really took it, really did well, and was able to.
Did you give a lot of it back, Mike?
No.
I mean, because that's the key. Because I knew a lot of people that anything with .com after it, they made $1 million. They were up $1 million, and they'd come to my office. They'd come to my office and go when it started heading down, and I say, well, why not liquidate? And they'd say, well, I'd pay a lot of taxes. I said, well, you should be grateful.
Absolutely.
Okay,
absolutely.
So it's better to pay taxes than write off $3,000 a year for the rest of your life.
100% correct. And when you pay taxes, it's a sign that you've done well, and there's nothing wrong with clicking and cashing in the cash register and taking profits and walking away sometimes. But look, I mean, a trader's mentality, some getting out is harder than getting in, and some traders didn't realize that back then, and they were just thinking everything was just going to continue going up in perpetuity, and that certainly wasn't the case. But yeah, I was fortunate. I was pretty grounded. My parents, I'm first generation American, and my parents and my mom and dad kind of saw what was going on, and they sort of reinforced it in me, saying, hey, look, this is be smart, be smart with what you're doing. And I took their advice and learned from my dad, used him as a role model, and was fortunate to not only did I not give it back, Dale, but I really I took advantage of the down move as well.
Wow, Mike.
And so we were in and out. We wrote it up and then wrote it down as well. So
that was your breakthrough year. I would say, and you say you learned in a year. I've interviewed well over 1,000 traders from all over the planet, and most of them say 4. Like, getting an undergrad degree before they had any breakthroughs, epiphanies, and can actually make a living doing it. It's funny.
The 1 year, it was a tough year, but I was young. And so maybe that's why I was young and willing to take risks. I Look, the light never clicks for many, you know. But for some people, yeah, I mean, 4 years, I could see that. Persevering for 4 years is tough.
It's taken me about 40.
Dale, I was just gonna say, do you ever really stop learning?
Yeah, right. I'm
yeah,
finally getting the hang of it.
Yeah, exactly. I mean, do you ever really stop? No. I mean, it's just it's a process, a journey that you just need to continue growing, and the market keeps changing, right?
Yeah.
And so you have to constantly adapt as well. And so that was the other thing too, was adapting from one style that was really successful during those years, the in and out day trading sort of strategy, and then transitioning over to a more buy and hold, taking a longer term perspective. That was very challenging.
So you were in the Souls Bandit camp back
then?
then?
I was a Souls Bandit.
Okay.
Yeah, there you go. They hated us. I started trading. I remember seeing GSCO. I mean, I knew Goldman Sachs was buying on the bid and the offer, and Morgan would be on the opposite side and whatnot. And so we used to see the market makers come into the market, and we could just kind of tag along with them. So
yeah, now you have to look at dark pools to get kind of a feel
now
for
you have no idea. Now you have dark pools and everyone's anonymous. But back then, I mean, it was you know, we used to follow, and they hated us, by the way. I mean, the market makers despised us because we were constantly picking them off. Before everything turned completely electronic and algorithmic, you had it was humans sitting on the desks at these market making firms, and you know, they had the one market maker who was in 50 names, and if he was trading, let's say Dell, which at the time was like a high flyer, there was no way he could watch the other 45 or 40 other stocks if that was his main concentration. And so we were able to pick these guys off, and so I know for a fact that we were not well liked and nor respected, but I didn't really care.
Yeah, you know, there's a story about father and son having dinner at a restaurant. The son kept playing with a quarter and putting it near his mouth, and his dad warned him, you know, be careful, son. You know, you could choke on that. And he turns his head, and next thing he knows, his son is choking from, you know, accidentally swallowing the quarter, and the father's giving him the Heimlich maneuver and everything. Nothing's working. And someone at another table, this guy sees what's going on, gets up, runs over, and kicks the kid as hard as he can in the nuts, and the quarter just popped out of his mouth. And the father goes, "Doctor, thank you so much for saving my son's life." And the guy goes, "I'm not a doctor. I'm a market maker."
Yeah, exactly.
Right, for the quarter?
100. Yep. I mean, that's exactly what would happen. I mean, they would get kicked, but every once in a while, they would swallow that quarter.
I miss those days of open outcry, Michael. Don't you? I mean, especially with the way markets behave now, where you have like, you know, 20-30% gap lower openings after earnings, and it's just the machines running things.
Yeah, I hear you. I think I would still be actively trading in the market if it weren't for the machines and the market maker and the algorithms.
Yeah.
It's changed so much, and that goes back to my previous point. You constantly have to adapt, you know, and adapting to algorithmic trading, adapting to a new strategy of transitioning from day trading to overnighting. That was a process, and again, so that really started to take shape in the early 2000s, where everything started really coming in on the algorithmic side, and then the market. And yeah, I saw the market changing and how it would trade, and I do miss it. I do miss those days. It was phenomenal. You know, again, look, I'll put myself up against any market maker, mano a mano. I'll trade against you, any human on the planet.
Great idea.
But you put me up against an IBM mainframe and a server, I'm defeated. I will tip my hat to that computer and that algo, and just know when to walk away. But you know, again, there's nothing you have to adapt, and there's nothing You can't live in the past.
No, I mean, I know a lot of floor traders, Mike, that could, once things moved off the floor, they made money just off the paper and the flow, and they didn't have to be right. And then you go off the floor and you have to be right to make a living, and many couldn't make that transition.
It was hard. It was hard.
So
yeah, I mean, I'm sorry.
Go ahead.
I continued trading from right up until I got the job here at TradeView. So I was in the market for 20 years. I started in 97 and I stopped in 2017. And again, constantly adapting and constantly tweaking strategies and whatnot. And then I was fortunate enough to land this position with TradeView, and I have no regrets whatsoever. I'm still actively, I shouldn't say that. I'm still somewhat involved in the markets. I have to watch because of my job, which dictates managing risk on the trading side. But I still, every once in a while, will still put a couple of positions on here or there.
Yeah, it's like Hotel California, Mike. You could check out, but you could never leave. So,
well said.
I want to talk to you. You said you wanted to cover the economy, and you were talking about adapting. And we did have a pretty good decline, and many people have not lived through any kind of bear market except for the COVID crash for 20 years. Okay. Well, at least since, people that came in after the recession, the housing crash, a lot of people are used to the Fed being their backstop. The Fed is trying to break the back of inflation by negative wealth effect. They stayed easy to bring us out of the recession through positive wealth effect, stocks going up, real estate going up, and people started feeling wealthy again. What do you think about what the Fed is doing here, right, Michael? Do you think that they're making another policy error? Do you think they're going to stay tight too long and sow the seeds of a recession?
Yes, I do, and I'm still somewhat bearish on the market here, despite this rally that we've had.
There's a rally right here.
And again, I say my opinion comes from history, and there's a historical precedence for this, right? I mean, the Fed has a tendency to show up to the party a little bit late, and they tend to overstay their welcome. And so I think that's happening here. They definitely should have been hindsight again, but they should have been raising a lot sooner. You've had this easy money policy for far too long. We had a government that was just injecting trillions of dollars into the economy. Everyone was feeling good. Everyone was feeling great. And now it's time to sort of pay that back. And if the Fed is serious about curbing this inflation, I know the last number, it was somewhat a little bit less than what was expected, and that was a welcome piece of information that the market digested. But I do think that if they are serious about curbing inflation, and I do think Powell is serious about trying to do more, that they're going to have to continue raising, and that will eventually tip us into a recession. And precedents, history has shown that that's usually the case. And I'm watching, I think a big chunk of the economy, let's take a step back. So the first 5-6 months of the year, just absolute, it was a bloodbath, right? I mean, everyone just liquidating. The sky is falling, right? The market overshoots from January until that June low. And then amazingly, and this is what I think took many by surprise, is that the US consumer hung in there, and you had a couple of good positive retail reports coming from the retailers and retail sales, and people were spending, and that was cause. I think that's a little bit of being oversold, but there was a little bit of reason behind the rally for us to have this move up from mid-July. And so now I think we're in this range, right? So now we've had this nice rally. Maybe the market's kind of feeling it's not as bad as we thought it was going to be. We're not going to fall off a cliff, and now we're just kind of in this. Well, we're still in an uptrend, but I do think I heard what your comment earlier. I do think I expect to pull back, and then I think we're going to start having like a little bit of a wedge pattern here from our highs to the lows. We're sort of going to sit in here. We're going to become a little bit range bound, and it's going to be a wait and see. But I do think as the Fed continues to raise rates, and I do think they will, going into the third and fourth quarter of the year, I think we'll see, the economy will fall into recession. How deep, I'm not sure, but that's my overall sentiment. The $1 million question, though, Dale, is, has the market priced in everything? Has the market priced in that this recession in the first 6 months of this year? And that remains to be seen. And so I think you have to just keep watching certain sectors. I think housing is a huge part, a huge component of what's going on. I would watch to see the data on the housing side come through over the next 3 to 6 months.
I've read some recent articles, and and there really is a drop in foot traffic, and the doubling of mortgage rates. That the housing market is in full retreat. The builders, and that's a big part of the economy, isn't it?
Of course it is, and there's the trickle effect, the trickle down effect that comes from housing. The construction side, people going out, they buy a new home, well, you're going to buy new furniture and whatnot, and so there's all these peripheral industries that are affected by it. And so, yeah, I mean, keep an eye on the housing. I think there was a report this morning that said, despite there was the slight decline in interest rates over the last couple of weeks, mortgage applications dropped. So there's signs that things are slowing down, and now how much of it is going to roll over remains to be seen. But that's one sector that I would keep a really close eye on and use that as a leading indicator, and pay attention to those housing numbers that are coming out. Pay attention to sentiment that comes from home building sentiment. If you look, you can, if you want to pull up a stock of, like, let's say a home builder like Hovnavian,
symbol
HOV.
Okay.
So we've had a pretty good rally in the market, but these home builders haven't really
participated.
Yeah, not too much.
Okay, so there's not at all.
Right. I mean, so this is
weak.
Yeah, very weak, right? I mean, you compare that to a chart, let's say Apple, if you want to look at Apple.
Apple's almost at new all-time highs.
Right. So you can, exactly. So again, these are.
Sounds like you learned a little bit from.
I learned from 08 too, as well, Dale. I 08, 07, 08. That was another great time.
But I could tell you look at relative strength and performance in the market by showing a weak and a strong example.
There you go.
That you understand the concept of leadership and laggardship.
What you have to, right? I mean, this is what it's the rotation of money, and so you can see it. A chart shows you where the money is going into and where it's not. And when you see a chart like Hovnavian, that's where the stock is just sitting there and it hasn't really participated in the market. Well, guess what's going to happen if we do get a pullback? This could be a name that could be a good shorting opportunity, and especially since stocks come off its highs, right? I mean, it's coming way off its highs, but it's telling you something that it hasn't participated in this rally in July. I don't think the market is really expecting much from the housing sector.
I mean, this looks like the type of stock. There's nothing impulsive.
Nothing there.
It's just, it works its oversold condition off, not in price with a big correction, but just in time. It works off its oversold condition.
Exactly. There's not a lot of money coming into here. So again, and that was my entire, that's the way I was taught, is that concept of relative strength. How strong or weak is the stock that you're looking at, the sector that you're looking at compared to the market. That's essentially how I was taught to trade. And again, this is a perfect example.
Tim Fury, who says, when the market's red, buy what's green.
That's it.
You know the guy, right?
I've heard of him. Yeah, I've heard of Tim. Yeah. Look, I remember Warren Buffett. Warren Buffett, be greedy when everyone's fearful, and fearful when everyone's greedy, right? And I remember, again, I go back to that internet. I remember in '99, where everyone's buying anything that was .com. People were just pouring money.
They were geniuses, weren't
right?
they?
Everyone was a genius, right? And I remember people on CNBC criticizing Buffett, saying he's done. His type of investing is his strategy is over, and man, a year later, a year later, he was just proven right again, for avoiding all of that. And again, so it's this concept. This is the way I was taught to trade. Look for you want to look for weakness. You want to look for strength. Compare everything to the market. See what's rallying and what's not, and that's where your ideas are generated from.
It's simple but powerful,
and difficult sometimes too to kind of pick up, where it does take time, and you need to piece that all together. You need to learn the market, and then you need to learn how to chart, and you need to understand these concepts. So it's not for everyone, but once that light does click, and it's just a simple chart like this, where you can say, hey, you know what, from July the stock hasn't done anything. What's going on here? All you really need to know is that there's no buyers in that name, and there's no money coming into that sector, and that's a potential short. That's something that you want to short going forward.
Okay.
You just want to keep it on the back burner.
All right. So you brought up the old school adage. Do you believe the inversion of the yield curve? Old school would say it's predicting the recession. Are you a believer in that? Sometimes you get false signals from an inversion.
It's happened, right? It's happened a couple of times over the last decade, right? It's shown, but again, so let's go back. I don't even think you can count COVID as a recession, right? Because that was just like that wasn't real. Granted, the market pulled back, but that was such an extraordinary event. This is
it only happens every 100 years.
Exactly, right? But this is a real. We're in a real cyclical part of the economy here, where we've had a bull market, Fed's raising rates, and now we're it's sort of teetering here on a slowdown. So this is what it normally should be. This is what a normal cycle looks like, right? And so I think there's some merit to this particular yield curve, if it does invert, and I think it's telling you something, right? But because it is much more normal, standardized in terms of what's going on in the overall economy, as opposed to, let's say, COVID in 2020, which was much more of a fluke event.
Let me ask you this, Mike. A lot of people are declaring the commodity bull market dead. Where do you come down on it?
Yeah,
here's a chart of corn, and of course, wheat. Ukraine was a big part of the story of wheat doing this. This was the invasion.
Yep.
Nickel. We're not having great weather, but I guess we're having a decent season. Mm-hmm. And they're selling off the grains. They're selling off the metals. They sold off copper.
If you want to put up a chart of nickel, that nickel move was
the squeeze of the millennium.
It really was. I know a couple of guys who got really hurt in that. But again, I think with this particular cycle here, so you have a Fed that's raising rates, and then you had to couple that with the Russian invasion, and so I think that exacerbated the worry, the fear in the market, and it sort of got some of these prices on these commodities a little bit out of whack. I do think that as we move forward here, I think you're going to see oil sort of continuing to trickle down, continuing to move lower, make lower highs. As the economy slows down, there's going to be less demand, and so I would be a little bit. I would agree that things are probably still, we're still going to be downtrending here, especially on the oil side.
I could understand economically sensitive commodities going down because of maybe economic weakness, copper, energy. But you know what? The Fed cannot print corn.
No, that's true.
Okay,
Very true.
so that's where I'm seeing. I think something that's out of central banks' hands is more in Mother Nature's hands, and I just have to think that we had huge runs, and a lot of this, I think, is deleveraging. That there might be an opportunity in the food space of commodities going forward, maybe after harvest this year.
That's a fair point. And you have, we still have a growing population that needs to be fed, and so overall those prices have
There's
a tendency.
water issues.
Yeah, I mean, there's global the global issue with regards to famine, and I know China's is buying up farmland in the U.S. And so there's the food commodities are a little bit different.
Yeah, they are.
If you take it if you segregate that a little bit from oil, but that's a fair point.
Okay, you have a view on the dollar, Michael?
Yeah, I think you're going to continue here. Unbelievable strength. As the Fed continues to raise rates, I think you're going to still see demand for the dollar, and you're going to see foreign investors coming in and taking advantage of our rates here and buying up our bonds. So I would not. I'd be a little bit hesitant to sort of call the top in the U.S. dollar here.
So would that leave you negative gold, or do you think everyone should own a little bit of gold in these uncertain times?
Gold is a very good hedge during inflationary times. We had that pop again. It peaked right before, I guess, the market bottomed, right?
Yeah.
And sort of kind of pulling in, but you should always have a little bit of gold in that portfolio, based on what your particular strategy is. But it's always a good idea to have a little bit of gold in there. The other,
go ahead.
No, go ahead. I was going to say the other hedge would, well, I don't even know if it's a hedge, but if you want to go into the crypto space and into,
okay,
yeah, I mean,
I'd like your view on crypto, and difficult for to have a lot of great price targets, but to me, there's nothing bullish there.
No, it's amazing the parallels between
tulips,
Bitcoin, and tulips, and internet stocks, and condos in 2008. I mean, it's really, you look back and it's history repeating itself, right? And
human nature.
It really is, and I'm not discounting the value and the meaningfulness of Bitcoin and crypto and having that in our society, but in terms of this mania, like you saw it, where people were just jumping in and anything, any kind of coin that they were putting out, they were just pouring money into it, and it was just taking off, and people were looking for that get rich quick scheme. And so it's history repeating itself. So yeah, there's nothing bullish about this right now. I think this is going to kind of stay a little bit range bound for the foreseeable future. I don't know when the last Bitcoin is going to be mined. I'm not sure how many are left, but again, I this is one area where I would just be a little bit weary of. And again, I saw that crash in 2000. I saw the housing market crash in 2008, and this felt and looks and has the makes of the same sort of move. And so there's many people out there who are bullish on this. They've gotten caught. They got caught in this, and I would be hesitant. I would be hesitant on this particular
Mooch was
sector.
on CNBC explaining himself. Anthony Scaramucci.
What was he saying?
Well, he had to close a fund, but he still believes in it long term. And same old story: close a fund and open a new one.
And again, it shook out the industry itself, shook out some of the weaker hands, and yeah, it's not going away. I'm not saying it's going away. I would just be hesitant about, be realistic about going back up to these highs.
I have noticed something a little technical. You see the action here in Bitcoin, this little kind of sideways uptrend compared to, and this is what we were talking about, Mike, relative strength, weakness. So I would say if Bitcoin made a new low, and I think it might trade 15, 14, and Ethereum is only retesting or only gets back to 12, that would be a nice buy in Ethereum.
That is a perfect relative strength setup right there.
All right.
That's
well,
exactly
I want
what
you
it's
to,
about. So there
when
you
do
go.
you want to set up your account, Mike? I mean, you could either, I used to open accounts, and I used to say, well, they go, well, I want to think about it. And I said, well, you could think about it and watch Dan Rather talk about it, or take the trade here
and do something about it.
Yeah.
There you go.
So Mike, really, I'm glad we had this conversation. It's great to meet you. And I'm sure there's some people that may even want to talk to you, about what they're going through in the markets right now. And, I know that we deal with non-residents of the US, but if someone wanted to get in touch with you, Mike, what would be the best way?
Yeah, please feel free. You can email me at Lombardo, LOMBARDO at tvmarkets.com. That's my email address. I'm on Skype at the same address, Lombardo at tvmarkets. I'm, again, so part of my experience as well, I ran a room. I actually was involved in education, and I would I had about 30 at my height, maybe 30 to 40 traders in my room, and we would set up daily meetings, and we would do 3-week courses. So I know the plight of the trader. I understand it, and know what a trader sometimes is when they're struggling, what they're going through, and how difficult it is, and how frustrating it could be. Why didn't this trade work? Everything was set up, and the psychology behind the market. So if you have any questions whatsoever regarding the market, please feel free. You can reach out to me on Skype, email me. I will always be, the door is always open, and I will always be ready to provide whatever sort of advice and I possibly could.
Okay. There's someone who cares, and a veteran who will help you avoid some of the landmines he's stepped on in his career. I know I've stepped on quite a few.
Quite a few.
And Michael, I look forward to your postings in TradeGATEHub in
Yes,
the future.
yes, we'll do.
And really appreciate being able to meet you virtually.
Well, maybe one day we can do it in person.
Okay, and really great to work with you guys at TradeView. Appreciate it. My trading warrior brother, Mike Lombardo, everybody. Hope you enjoyed it, and good hunting, Mike, and rooting for everything you do.
Thank you, Dale, and I appreciate your time here, and please keep up the great work on TradeGATEHub. You and Mike V are doing an amazing job.
All right, glad to add value, buddy. And
Thanks,
that's a wrap, everyone. Good luck trading. Mike's going to be with you in about 27 minutes. With the market selling off today, I know Mike had some shorts, so come in the room and ask him what he thinks is going on and what he's doing. And we'll see everyone. I'll see everyone tomorrow. I have Lakshman Akutang of Economic Cycles. The guy's been around for 25 years. He's one of the best economists I know. So tune in for that tomorrow at my regular time, 9:30 a.m. EST. And don't just count your winning and losing trades, count your blessings. Adios, and see you later, Mike.
Thank you. Thank you, Dale. Have a good one.